It is Sunday, March 22nd, 2026. The global financial landscape is paralyzed by maximum fragility. President Donald Trump has issued a 48-hour ultimatum to Tehran. The ultimatum demands the immediate reopening of the Strait of Hormuz. Traffic through the world's most critical energy chokepoint has dropped by 95%, severing the primary artery of global oil supply. This follows a devastating Iranian missile barrage. Strikes hit Israeli towns of Arad and Dimona near a known nuclear facility, wounding over 100 people. The pricing reaction across global markets was immediate. Brent Crude is currently surging toward the $111 per barrel threshold, upending energy cost models worldwide. Risk managers across the globe are sounding alarms. Major asset classes are teetering on the edge of a structural breakdown as geopolitical guardrails are removed. Markets are no longer pricing in a localized conflict. Trading algorithms and institutional desks are now modeling a systemic global supply chain collapse. As the 48-hour clock ticks down, we're witnessing a historic capital flight. Institutional funds are selling emerging market equities to hoard liquidity in safe haven currencies. The India VIX, a key gauge of fear, has spiked over 18% to 21.05, signaling deep panic. Overlaying the price of gold, we see it reclaiming its status as the ultimate hedge, surging past $5,022 as funds seek shelter. Institutions are demanding the physical accumulation of these assets. They are preparing for counterparty risks that could trigger if the maritime blockade expands. The entire financial system is captive to a binary geopolitical outcome. This uncertainty forces a massive cross-asset contagion that leaves almost nowhere to hide. Looking at the U.S. equity complex, a heavy bearish bias swept through institutional trading desks heading into the weekend. The S&P 500 is struggling to hold its primary structural support at 6,600. A breach points directly to a systematic slide into the 6,450 zone. Consequently, Morgan Stanley warns 2026 earnings per share growth forecasts will aggressively re-rate downward from 16% to sub-10%. Beneath the surface, a violent sector rotation is occurring. Record capital is flowing straight into defense contractors like Lockheed Martin and Northrop Grumman. At the exact same time, consumer discretionary stocks are falling, derailed by the sudden reality of crippling fuel costs hitting the consumer. U.S. macro pricing has detached from traditional domestic benchmarks. Every tick on the tape is dictated entirely by the Trump war premium. Europe is the most exposed region to this Middle Eastern blockade. The markets here are locked in a state of fragile stagnation. The primary threat driving this stagnation in Germany's DAX index is a historic liquefied natural gas, or LNG, supply shock. The blockade has choked off Qatar's Ras Laffan exports. This physically severs Europe's natural gas lifeline, sending replacement energy costs higher. This DAX chart illustrates the technical damage, tracing a bearish pennant formation trapped between 23,200 and 22,500. The contagion spreads beyond energy. In France, the CAC 40 is breaking down, as severed helium and cooling gas supply chains threaten to halt aerospace manufacturing. The European Central Bank is cornered. They face imported inflation from energy costs, right as industrial growth stalls, forcing traders to dump growth equities and hide in defensive utilities. The reaction in Asia has been a systemic wipeout. Friday's trading session saw a catastrophic 3.38% plunge in the Nikkei 225. The root cause is a structural vulnerability. Japan relies on the Middle East for 90% of its crude oil, a dependency so severe the government is already tapping strategic reserves to keep the lights on. On this Nikkei candlestick chart, a massive bearish gap has opened at 55,000, dropping toward the 52,500 demand zone. Asia is caught in a supply chain pincer as input costs for synthetic rubber, plastics, and semiconductor gases surge by 40%. There is a secondary contagion hitting the foreign exchange markets. The US dollar to Japanese yen pair is pushing toward the 160 mark, sparking anxiety that the Bank of Japan will be forced to intervene. This dynamic creates an existential margin crisis for the region's electronics and automotive sectors. It erases the optimism from China's recent industrial production beat. Geopolitical epicenters rarely offer safe harbors, yet Arab markets like Saudi Arabia and the UAE are experiencing extreme intraday volatility rather than a pure collapse. Saudi air defenses spent Sunday morning successfully intercepting and destroying multiple incoming drones over Riyadh and the eastern region. The Saudi TASI index reveals a bullish divergence at the 10,800 support level, where price drops but momentum climbs. Global funds are actively exploiting the setup. Benefiting from $110 crude, institutions use the TASI as a geographic energy hedge against European stagflation. However, retail sentiment remains chilled by a severe tail risk. Iran has explicitly threatened to strike regional desalination and power plants. Institutional capital is parked in a neutral contingent posture. They buy energy revenues, provided local infrastructure survives the next 48 hours unharmed. Let's track the capital flow. The US dollar index, or DXY, is pushing against a hard resistance ceiling at 100.50 as the safe haven bid. Where are those dollars coming from? Foreign institutional investor liquidations. In India alone, over 10,700 crore rupees was pulled out Friday. Domestic institutional buyers stepped in to absorb some of that shock, creating a high-stakes tug-of-war that is currently tearing emerging markets apart. In the midst of this, Bitcoin is exhibiting highly irregular behavior, holding a price point right around $70,394. It is not being treated as a currency here. Traders are using Bitcoin strictly as a high-beta risk-on proxy to trade the geopolitical panic. Beta is a measure of an asset's volatility in relation to the overall market. The mandate for risk managers right now is clear: sell emerging market equities, hoard US dollar liquidity, and hold high-volatility hedges just to survive until Monday morning. The 48-hour window closes as the markets open on Monday morning. Without a formal, verified de-escalation from Tehran, the institutional consensus is clear: global markets will face a severe gap-down open. This chart maps the technical risk for the Nifty 50. It closed just over 23,100, but if the 22,950 floor fails, the structure breaks, opening the door for a slide to 22,500. For defense, capital is migrating to public sector energy and mega-cap IT names. These sectors are mathematically advantageous in this environment. IT acts as a natural hedge against a weakening Indian rupee, while energy producers directly benefit from the spike in oil prices. But there is a final tail risk that overrides all modeling. If Israeli retaliatory strikes target Tehran's power plants, Brent Crude will instantly price at $125 a barrel. Earnings reports and forward guidance no longer matter. Global equities are entirely captive to the binary